turn our attention now to crude oil prices. Oil and gas crude prices have surged overnight. Oil marketing companies have been buzzing lately. Probal Sen, the energy analyst at ICICI Securities, now joins in with his call on the oil and gas space. Probal, first, an open-ended question. What is the outlook for 2024? The top three themes that will dominate the oil and gas sector next year, according to you, and how will this then impact the stocks?
Well, obviously, crude prices, as you mentioned, is always the number one monitorable that remains of interest. At this point of time, I think what is of interest is that crude remains in a fairly sweet spot as long as it remains in the range of around $75 to $85 per barrel. I think OMCs as well as upstream continue to remain in a comfortable space. The reason I say that is if you look at the last period when prices were actually held up for retail fuels, crude prices at that time and implied product prices were in the range of 90 plus. So any price about $5 to $6 less than that continues to allow leeway to make healthy marketing margins. Even if you were to assume that there could be a price decrease that could happen in gasoline and diesel prices, there is enough of leeway for the OMCs to continue to make reasonably healthy marketing earnings. Alongside that, our call very clearly is that if you look at the refining space, if you look at the overall crude space, there is a bit more tightness that we expect to come in the next 12 to 18 months than what is sort of reflected in the prices right now. Our sense is that demand growth for crude continues to be underestimated fairly consistently over the last decade by most forecasting agencies. And invariably what happens is that once you start to play catch up, and demand growth starts to exceed estimates, there could be a little bit of tightness in prices coming in maybe over the latter half of next year. And that's something, of course, that will depend on how the supply shapes up, specifically from OPEC, where there is increasing concern that, the supply cuts may not actually come about to the extent that they have been declared because compliance will become an issue for some of the smaller OPEC nations. Having said that, overall, our sense is crude will probably be in the range of around $80 to about $90 with the bias probably on the upside at this point of time. So to that extent, for upstream specifically, I think that is a fairly good range because even with windfall taxes being there, net realizations have consistently remained at $75 to $77, and that is still much higher than their last 8 to 9 year averages. So as I said, crude prices and GRMs probably would be two key monitorables. As far as gas is concerned, I think even in this year, what we have really seen is that with winter probably being slightly normalish, the inventory buildup in Europe has been so strong that even without any Russian gas supply, even in this year, the spike in LNG prices has actually been far less than what you would have expected. Spot LNG prices, if you really look at it, spiked to about $17 to $18 in October. They've sort of been driven back down to about $15. So that again is fairly good news from gas consumption and margin standpoint. Because what the slightly lower crude also does is that even term LNG prices, if you factor in the fact that they're at roughly about 13% linkage to crude, those have also sort of softened by about $1.5. And that is a fairly significant delta, particularly from the CGD standpoint and overall gas demand standpoint. Every dollar decrease in gas costs improves gross margins by anywhere between 1.5 to 2.5 rupees per SCM for the CGDs. And I think, if not passed on, of course, and, the lower gas cost also, should allow for slightly higher gas demand, which is good news for a player like GAIL, for example. So things from a macro standpoint actually look fairly healthy. Obviously, anything can, happen given that the Russia-Ukraine conflict remains uncertain. Now there are concerns that it is spreading towards the Red Sea and disrupting shipping freights. We don't know how much US production will grow, after the stunning growth that we have seen in this year. So there's lots of questions, but based on, the data that we have right now and from what we can see, I think the next 12 months should be fairly strong for the entire space.
Probal, hi, season's greetings. And it's interesting that you mentioned that. So let's for a second leave out geopolitics because, no one can predict what might happen tomorrow in the Suez. But given everything else that you said, from an investor standpoint, if I want to add, a couple of energy names to the portfolio for 2024, then what should I be looking at? City gas distribution, as you said, because there's probably a margin delta playing out there. Should I go with, Reliance for a second? If we just look at the oil and gas side of the, of the business over there, could Reliance be a big play? What should be the top must-haves in the energy complex in the portfolio in the next year?
So what we have been basically looking at, I think if I look at across, let's say starting with upstream, we would be definitely positive on both ONGC and Oil India for different reasons. As I said, realizations continue to be strong, and after a long period of delay, the KG Basin asset from ONGC does look like it's closer to commissioning now. Sometime in the in January, full-fledged startup should happen, and that will reverse the last 7-year trajectory of production decline. Oil India also is showing a healthy growth in production. They have put in place fairly aggressive targets for growing both oil and gas production over the next 3 to 4 years. So, and of course, they benefit from the fact that NRL, which is also doing an expansion of its refining capacity in a fairly reasonably strong GRM environment, that adds to the consolidated group earnings in a major way. So to that extent, I think Oil India also looks good. In downstream, HPCL, is probably one that I would look at. They are expanding their refining portfolio significantly. They're adding to their petrochemical capacity, which changes the margins mix quite significantly, as well as changing the scope and scale of the business. Leverage continues to remain comfortable, and even if you build in fairly normalized marketing margins, my sense is that earnings for 25 and 26 will continue to see upgrades, the way that FY24 earnings have seen upgrades across the street in the last 2 months. And valuations remain at less than 4 times 1 year forward earnings, which is, I think, a fairly reasonable level. Enter the story. As far as gas space is concerned, we would probably play GAIL and MGL as the 2 players. I think for GAIL, the rising gas demand, as I just mentioned, along with the softening of LNG prices, is probably a significant delta for earnings across segments. And MGL is one name that stands out in my mind in CGDs, because there is sustained margin strength, steady volume growth that is in prospect, and any improvement in gas costs, even from here, should add to the margin profile. So those are the 5-6 names. Reliance, yes, the OTC segment obviously should benefit if refining continues to stay strong.
Fair enough. So ONGC Oil, GAIL, MGL, and Reliance as well. HPCL, of course, in the oil marketing pack. Probal, thank you very much. Great speaking with you. Appreciate you joining in with that quick chat on the oil and gas space. Now, 9:10.